December 19th, 2001. Two men wake up at the same hour. The first is Eduardo, a banker. He lives on the 14th floor of a glass tower in Palermo. He has a pension, a savings account, a leather briefcase he's owned for 12 years. Yesterday, his economy was one of the fastest growing in Latin America. The second man is a street vendor named Carlos. He sells empanadas from a cart. He has 40 pesos in his pocket and a debt he can't pay. By nightfall of that same day, Eduardo and Carlos are standing on the same sidewalk. Same street corner, same panic in their eyes. The difference? Eduardo had more to lose. In 72 hours, Argentina's economy, the darling of the International Monetary Fund, praised as a model for the developing world, collapsed. Not slowly, not gradually. It collapsed like a building that had been rotting for years, but fell on a Tuesday afternoon, while everyone was having lunch. Here's the question. Nobody asks loudly enough, how does a strong economy just stop working? We've been told a comforting lie. The lie goes like this. Economies collapse because of bad decisions. Poor countries, corrupt leaders, fiscal irresponsibility. The narrative always implies that you would have seen it coming, that the warning signs were obvious, that the people inside were somehow blind. But here's the part nobody tells you. The most catastrophic economic collapses in history didn't happen to failing economies. They happened to booming ones. Weimar Germany, 1923. Industrial powerhouse, one of the most educated workforces on earth, collapsed into hyperinflation, so severe that workers were paid twice a day so they could spend their wages before lunch. The United States, 1929, the roaring 20s, stock markets at all-time highs, every indicator pointing upward. Until one morning, they weren't. Japan, 1991, the economic miracle, 30 years of unprecedented growth, companies buying American landmarks. Then, silence, a lost decade that became two. The pattern isn't failure. The pattern is success itself becoming the trap. This is the first law of economic collapse. The stronger the economy appears, the more invisible its fractures become. Part 1. The confidence trap. New York City, 1927. Shoeshine boy named Jimmy is giving a tip to a Wall Street broker as he polishes his Oxfords. You should buy Radio Corporation stock, Jimmy says. Everyone I know is buying it. The broker, a man named Charles, laughs. Not because it's funny, because Jimmy has been right 3 times this year. In 1927, everyone was right. The stock market had been climbing for 5 straight years. Banks were lending money to ordinary people so they could buy stocks. Stocks were used as collateral to borrow more money to buy more stocks. The whole system was a tower built on the assumption that it would never stop growing. This is what economists would later call irrational exuberance. But in the moment, it felt like intelligence. Charles Kindleberger, one of the greatest economic historians of the 20th century, wrote about this pattern across centuries. Manias always feel rational from the inside. And this is the trap. When an economy booms long enough, a dangerous psychological shift happens. Risk stops feeling like risk. Caution starts to feel like cowardice. The people who warn about excess get ignored, or worse, mocked. By 1929, American, banks had issued loans equivalent to 40% of the entire stock market's value. On October 24th, Black Thursday, when prices began to slip, those loans became a death sentence. Everyone needed to sell at once, but there was no one left to buy. In 48 hours, $30 billion in wealth vanished. In today's money, over $500 billion gone. The first law, confidence is the oxygen of an economy, but too much oxygen causes fires. Part 2, the architecture of illusion. Tokyo, 1988. At the peak of Japan's bubble economy, the land beneath the imperial palace, roughly the size of a large city park, it was worth more than the entire state of California. Read that again. A park worth more than California. Japanese banks were lending money based on the paper value of land, which was being driven up by the loans themselves. It was circular, beautiful, and mathematically impossible to sustain. The economy wasn't just growing, it felt invincible. Japanese companies were buying the Rockefeller Center, Pebble Beach Golf Course, Columbia Pictures. There was a cultural belief that Japan had discovered a new form of capitalism, that the old rules didn't apply. Then, the Bank of Japan, worried about inflation, raised interest rates 5 times in a single year. The property values that backed all those loans began to fall, quietly at first, then fast, then faster. By 1992, the Nikkei stock index had lost 60% of its value. Property prices would decline for the next 14 years. Banks stopped lending, companies stopped hiring, young people stopped spending. The whole country entered a psychological freeze that economists eventually named the balance sheet recession, a state where even healthy businesses refuse to grow, because the scars of the crash make risk feel like suicide. Japan never fully recovered its 1989 peak. Some economists argue it still hasn't. The second law, every economic miracle contains within it a hidden architecture of illusion, and the stronger the illusion, the longer the collapse. Part 3, The Wolf at the Door, Thailand, July 2nd, 1997. A phone rings in a trading room in Bangkok. The Thai baht has just been devalued. Within weeks, the crisis spreads to Malaysia, Indonesia, South Korea, the Philippines. Currencies collapse in sequence, like dominoes. Stock markets lose between 40 and 80% of their value. In Indonesia, 20 million people fall below the poverty line in 6 months. This was the Asian financial crisis, and almost nobody saw it coming, because almost nobody was looking at the right thing. The tiger economies of Southeast Asia had been growing at 10% annually for a decade. Foreign investors were pouring money in. Infrastructure was booming. The World Bank called it the East Asian miracle. Underneath, something was misaligned. These countries had borrowed massive amounts of money in US dollars while earning in local currencies. When investor confidence shifted, when one fund manager in New York decided to hedge his bets, the outflow of foreign capital turned into a flood. The currencies cracked. The dollar-denominated debt exploded in local terms. Companies that were profitable yesterday couldn't service loans today. George Soros and other speculators, some call them predators, some call them rational actors, bet against the currencies and won billions as entire nations burned. The IMF arrived with conditions, austerity measures, spending cuts in the middle of a crisis. The wolf was always at the door. They just hadn't heard it knocking. The third law, the most dangerous debt is the debt denominated in someone else's currency, because you can never fully control the terms of its destruction. But wait, we've talked about confidence, about illusions, about structural debt. And you might be thinking, okay, so economies collapse when people borrow too much, or when currencies get attacked, or when bubbles pop. That's a reasonable conclusion. It's also incomplete. Because here's the deeper pattern, the one that cuts across all of these stories, the thing that Argentina, Japan, Thailand, Weimar Germany, and 2 America all share. They didn't collapse because of what went wrong. They collapsed because of what had gone right for too long. Prosperity creates complacency. Complacency dismantles safeguards. Missing safeguards allow excess. Excess builds fragility. And fragility, given enough time and one unexpected shock, becomes catastrophe. Economists call this the Minsky Moment, named after Hyman Minsky, an American economist who spent decades warning that stability itself is destabilizing. His colleagues mostly ignored him during the good years. By 2008, they were citing him everywhere. The cruelest irony in economics, the longer a system avoids crisis, the more dangerous it becomes. Because the absence of pain teaches everyone that pain is impossible. And that is when the real trap closes. Part 4, the 2008 autopsy. Bakersfield, California, 2005. A strawberry picker named Albertino Ramirez earns $14,000 a year. He is approved for a $720,000 home loan. No income verification required. This is not a rumor. This is a documented case cited in the film The Big Short. And it was not unusual. It was the norm. American banks had discovered something intoxicating. They could make risky loans, package them together into complex financial instruments, sell them to pension funds and foreign banks, and collect the fees without keeping any of the risk. The risk had been spread so thin across the global financial system that nobody knew where it actually lived. Rating agencies, the firms paid to assess a danger, gave these packages of toxic mortgages their highest ratings because they were being paid by the banks that created them. Alan Greenspan, the most powerful economist in the world and chairman of the Federal Reserve, for nearly 2 decades, believed the market would regulate itself. He had testified to Congress for years that derivatives, the complex financial instruments wrapping all this debt, made the system more stable. In 2008, when the whole architecture collapsed, Greenspan sat before Congress again. A senator asked if his worldview had been proven wrong. Yes, he said quietly, I found a flaw. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy in a single morning. Stock markets worldwide lost $10 trillion in value within weeks. Unemployment in the US doubled in less than a year. Iceland's entire banking system collapsed. Iceland, a country of 300,000 people, had allowed its banks to grow to 10 times the size of its national economy. When they fell, they took the country with them. Ireland, Spain, Greece followed. The contagion moved like weather. The fourth law, when the system becomes too complex to understand, it becomes too dangerous to trust, and the moment everyone trusts it completely is the moment before everything breaks. Part 5, the pattern behind the pattern. Let's step back. Stand far enough away from history and something remarkable comes into focus. Every major economic collapse follows the same emotional arc. First, there is growth. Real legitimate growth. Things improve. People's lives get better. This is real. This is earned. Then there's overconfidence. The growth was real, so the assumption grows. It will always be real. Risk-taking increases. Regulations loosen. The memory of the last crisis fades. Then there is excess. Prices disconnect from value. Debt disconnects from income. Financial instruments disconnect from the assets they represent. The system becomes, as the writer John Kenneth Galbraith once described it, a world of illusion that exists only in the minds of the participants. Then there is a trigger. It can be anything. A central bank rate hike. A currency attack. A single investment bank's bad bet. One revelation about accounting fraud. The trigger is almost never the cause. It's just the thing that makes the illusion impossible to maintain. Then there is collapse. Sudden. Devastating. Followed immediately by the universal human response. Nobody saw it coming, but someone always did. Irving Fisher in 1929. Hyman Minsky across decades. Nouriel Roubini before 2008. Raghuram Rajan, who presented a paper at the Federal Reserve Zone Conference in 2005, warning that global financial markets were becoming catastrophically risky and was called a Luddite by the room full of economists. History doesn't lack prophets. It lacks the will to listen to them. And why? Because in a booming economy, the person who predicts collapse is the enemy of good feelings. Markets don't just trade in money, they trade in mood, in narrative. In the shared human story of this time, it's different. It is never different. Here's the thing that ties all of this together. Economics is not a science of numbers. It is a science of human behavior, of fear and greed, of memory and amnesia, of what stories we choose to believe about ourselves. Strong economies don't collapse because they were secretly weak all along. They collapse because human nature has a clock built into it. A clock that, given enough prosperity, begins to tick toward recklessness. Given enough recklessness, ticks toward fragility. Given enough fragility, ticks toward catastrophe. And then, and this is the part that breaks your heart, given enough catastrophe, ticks back toward recovery, toward growth, toward the next boom. And then the cycle begins again. Eduardo the banker and Carlos the street vendor both lost everything in Buenos Aires on December 19th, 21. 20 years later, Argentina is experiencing another crisis. Different details, same architecture. The Roman Empire collapsed. The Dutch tulip mania collapsed. The British Empire's finances collapsed. The Soviet economy collapsed. Each one, in its own time, was described as too big, too powerful, too essential to fail. None of them were. None of them are. The economist Carmen Reinhart spent decades studying financial crises across 800 years of history. The title of her landmark book says, "Everything. This time is different." Those 4 words, the most expensive words in human history, because every generation believes them, and every generation pays the price. Every empire has a last good year, a final autumn where the harvests are abundant, the markets are humming, and the people in power are absolutely certain. The way only the powerful can be certain, that what they have built will outlast them. It never does. Not because they were foolish, but because confidence, given enough time and enough silence, always outgrows the system that earned it. The question is never if it falls. The question is whether you're paying attention when it does. If this made you think differently about the world, subscribe.